individual in the 18th century. It was just a collection of people who, rented a room out and decided to, convert themselves into brokers. They started selling commodities. They started selling shares of companies much later, but initially they were, trading things like banyan trees and vegetables and fruits in BSE. And then later on, it was converted into a stock exchange. It was just a market where people could come and sell any commodity or any vegetable or fruit as such. So stock exchanges basically are entities that are created under Securities Contract Regulation Act, and all stock exchanges have to be companies now. Both BSE and NSEs are companies, and they have to be corporatized and demutualized. So every entity like BSE, which was not a company before, they'll be given a scheme where they will be initially converted into a company, which is called corporatization, and the powers of management will be handed over to some of the people who are not the members of the company. So it will be professionally managed. Companies usually do it with the board of directors. Here, the board of directors comprises of different set of brokers and other members. So the whole process of getting an entity which is either a body of individual like BSE or NSE, and then converting them into the company, that entire process is done through a scheme, and that scheme is called corporatization and demutualization. Stock exchanges in our country, therefore, after BSE and NSE, if any other stock exchange is set up, they have to be a company going forward. Both BSE and NSEs provide you the market to invest in securities, so they are acting as a market for securities. They are also responsible for providing good value to investors along with stability. They also help us in using our savings and providing us investment opportunities, as a result of which investors can practice speculation. They can make profits from fluctuations in prices, which is called as speculation. And then BSE and NSE also have investor protection mechanisms, just like SEBI's main objectives require. And they have introduced many such protection mechanisms like faster trading terminals, faster delivery of securities, dealing only in online securities through demat account, etc. So these are some of the measures through which investors are always protected, and only genuine companies can be listed on BSE and NSE, because they have to submit their financial statements directly to BSE. They will scrutinize your financial statements, and only then they will allow you to be listed on the stock exchange. So once you're listed, your company securities can be distributed amongst the investors, whether through an initial public offering or a further public offering. And every country, the stronger its stock exchanges are, the better GDP growth that country will display, and also an overall growth potential of any country is also similar to how well the stock exchange functions. So that acts as an economic barometer. Also, it ensures that companies don't cheat their investors. The regular financial statements, updates, etc. are always published by companies via the stock exchanges. So all the reports that an investor needs in order to find out how his companies are doing, that details are always available on a stock exchange. And as a result of these factors, foreign investors also get attracted to both BSE and NSE, and a lot of foreign investors, including FVCIs and FPIs, which we saw in previous chapter, they start investing in countries like India because of a strong stock exchange. Since BSE and NSE are there in India, they have created many more rules for dealing with companies and investors. So, as an average investor, you always have the ability to uh, ask questions directly to companies through the stock exchange portals. You can always get information and data about companies, and all of this promotes a very fair way of dealing in securities of companies. And companies also, from time to time, have to follow these rules and regulations and update their investors regarding what is currently happening with their organization. So in India, currently, there are only two recognized stock exchanges. Now, a recognized stock exchange, as we have already seen, contains nationwide trading terminals, which is very important. And they also need to be a company. They also need to have adopted a scheme of corporatization, demutualization, and they have common settlement mechanisms. They follow T+1 system, and all their settlement is carried forward by entities called as clearing corporations. So both BSE and NSE have outsourced their clearing functions to specific entities. Stock exchange, from primary market perspective, we have seen there are a lot of investors in Chapter 1 invest in securities of various companies. Now, secondary market perspective, all the trading and transactions occur through BSE itself. So BSE's main objective and NSE's main objective is the same as SEBI's objectives. SEBI's main objectives includes protection of investors' interest, promotion and development of the securities market, and regulator of the securities market. These are also the objectives of the stock exchange. BSE and NSE are governed by four regulations mainly. One obviously is the SEBI Act. Since BSE and NSE are companies, they also have to follow Companies Act. In addition to that, since they are dealing with securities, they have to comply with Securities Contract Regulation Act. And since they deal with electronic shares, they have to also follow Depositories Act. And they are constantly in touch with both NSDL and CDSL. So the four laws that both BSE and NSE have to comply with are SEBI Act, Companies Act, Securities Contract Regulation Act, and depositories have been converted into T+1 mechanism. T means trading day, and additional 1 working day is required for you to receive the securities that you have purchased in your demat account. So that is how most of the transactions work. All securities in BSE can be categorized into two types. You have listed securities for those companies who have signed the listing agreement. Their securities will be listed on the stock exchange. But all those companies who have not signed the listing agreement, some of those company securities also will be permitted to be traded in other stock exchanges apart from BSE and NSE. So certain companies who have not signed the listing agreement may be allowed to be traded in Hyderabad Stock Exchange or Delhi Stock Exchange, etc. So such company securities are called as permitted securities. So if you want your securities to be available pan-India all across the country, then you need to sign what is called as the listing agreement. In this agreement, the company and the stock exchange are the two parties who sign this agreement, and they agree to abide by the rules that is set by the stock exchange. In the secondary market, you have intermediaries exclusively for the secondary market. So just like we had 5 primary market intermediaries, we now have secondary market intermediaries also. Secondary market intermediaries, their main functions.
So I think someone's waiting to be let in.
So secondary market intermediaries are those apart from the ones that we have seen in the previous chapter. So merchant bankers are excluded, RTAs are excluded, underwriters are excluded, bankers are excluded, DTs are excluded. Foreign portfolio investor is a QIB. Depository participant is a intermediary. Credit rating agencies are also intermediaries. Research analysts are like newspapers. They publish information regarding companies and they will give you free advice regarding what they feel about that particular company, whether you should buy that company's shares or whether you should sell it or whether you should hold on to it. So they give you three recommendations: buy, sell or hold. And then you have investment advisors who will take care of your overall investment portfolio. They are also secondary market intermediaries. Custodians are very similar to depository participants. Depository participants are your link between NSDL and CDSL. Both of these are called as depositories. They will help you in converting your securities electronically and processing your corporate actions and dividends on time electronically. So NSDL and the investor, both of these people are connected by the depository participant. The depository participant acts as a link between the investor and the depository. Depository in turn connects the investor not only from the stock exchange to the company, but also the depository directly reports to SEBI regarding electronic transactions. So depositories are a crucial link between companies and investors, as well as SEBI stock exchange and the investors. But they only deal in electronic transactions. For physical transactions and physical share certificate, you have somebody called as the custodian. They will take care of your physical share certificate. You can consider them as a safe keeper of your physical share certificates. Whatever functions the DP does for electronic share certificates, custodians will do it for physical share certificates. Portfolio managers and investment advisor are also very similar. Investment advisor will tell you where to invest and how much money to invest. Research analyst will only tell you whether you should buy, sell or hold, but they give you free investment advice. So it is not very reliable. Investment advisor will take care of your investment potential. He will analyze your risk appetite and he will then give you the investment advice. Portfolio manager, on the other hand, will take care of end-to-end investment solution. So they will control your bank account also. They have the ability to withdraw or add money to your bank account. They will decide exactly how much money should go into a particular security themselves, and they just need to, not only will they give you advice, they will also take care of how much money exactly is actually being invested. So they end up taking a much higher commission for managing your entire portfolio. Stockbrokers are, on the other hand, members of stock exchange. Just like investors are members of companies, stockbrokers are members of stock exchange, and only they can buy and sell securities of any stock exchange. So these depositories and depository participants will then get in touch with the stockbrokers and they will then purchase or sell the securities on your behalf. So those are the basic nature of these intermediaries.
So whichever is not a primary market intermediary is a secondary market intermediary.
You can say pretty much yes. There are only two types of intermediaries, though I would like to put credit rating agencies into the category of other intermediaries or other market intermediaries. You can also put foreign portfolio investor is not an intermediary at all. He's just an investor so you can take them out also. And people like research analysts are not really intermediaries, they just provide you information, so you can put them also into the category of other market intermediaries if required. But your book basically divides them into two types. So we will continue to use the same methodologies. Anybody who's not a primary market intermediary is going to be a secondary market intermediary as per this particular chapter. Stock exchanges, they will directly get connected with both the depositories of India. Just like there are two stock exchanges, there are two depositories in India also, NSDL and CDSL. NSDL and CDSL will be approached by the depository participants. They are agents of the depositories. They will connect you, the investor, to the depository directly. So opening of your demat account, maintaining your securities, updating the balance, giving you SMS alerts, all of this is done by the depository participants. You cannot buy and sell without a demat account. Therefore, helping you open the demat account also is done by the depository participant. Stockbrokers are also sometimes called as trading members. This name is used interchangeably. They are members of the stock exchange, as I already pointed out. Now, stock exchange has some members who are stockbrokers. Stockbrokers have some more members who are called as sub-brokers. They are members of a stockbroker. So a sub-broker is a person who will help you in buying and selling of securities from a particular broker. So they are acting as assistants of the stockbroker. So whenever you want to buy, sell, or deal in any securities, you place an order through your demat account, which is created by a DP, but that order will be placed through a broker. So a broker also has to assist you in purchasing and selling these securities directly. Custodians are people who will hold your securities physically. They will also hold your money whenever you require. So they act as a bank locker, you can say. They will take care of your money and they will take care of your securities. Whenever company declares a dividend, they will collect it on your behalf. Clearing corporations are responsible for the settlement. Settlement meaning whenever a transaction takes place, whether there is a purchase or sale. Suppose there is a purchase order. You have placed a purchase order, so you should pay money. So collecting money from your bank and then giving it to the seller, and collecting the securities from the seller and giving it to you. This job of collecting money and securities and delivering it to the people who are supposed to receive it, this process is called as settlement. This is the process of collecting money and delivering money and securities to the respective investors, whoever is buying and selling accordingly. This job is outsourced in BSE and NSE both to clearing corporations. They are specialists in settlement mechanisms. We already know who are merchant bankers, so we don't have to worry too much about it. Now, there are special type of funds that are exclusively going to deal in securities that will track an index. So BSE index, the name of the index is Sensex. NSE index, the name of the index is Nifty. So whenever a mutual fund or a fund collects money from its investors, so investors will pool in different amounts of money. So let's say all of you pool 1,000 rupees. There are 18 of you. So 18,000 rupees will be collected by this fund, and this fund will invest directly in BSE Sensex or NSE Nifty. Such a fund which exclusively deals in securities of an index as part of a BSE or NSE, such a fund is called as ETF. ETFs are usually more safer, and their performance will be similar to the performance of BSE Sensex and NSE Nifty. So if Sensex goes up, you will get better returns. If Nifty goes down, you will not get good returns. Your returns will also go down. So however Sensex performs, your fund will also perform similar. Such a fund is called as a exchange traded fund. They are a type of mutual fund. They are not an intermediary like your book wants you to believe. They are just a type of mutual fund. Derivatives are of four types: futures, forwards, options, and swaps. Derivative will derive its value from an underlying asset. So they don't have a value of their own. They will derive their value from either a commodity or a metal like gold and silver, or a company like Infosys and Wipro, or sometimes even commodities like almonds, badam, and turmeric, etc. And the four major derivatives are futures, options, forwards, and swaps. There are few advanced derivatives like caps, floors, and collars, which are not traded in India again. India only deals with futures and options. A derivative basically can be any type of instrument, which can be either a commodity derivative, a currency derivative, or a security derivative. It is a contract which derives value from a commodity, currency, or a security. And it is a future-oriented contract, meaning it is a contract that will not be performed immediately, to be performed in the future. There will be a particular price that the parties will decide, and then they will enter into this contract. So such a contract which deals in a commodity or a currency or a security in the future is called as a derivative. Currency derivatives use popular currencies like USD INR or Euro INR. So since we are Indians, we will deposit rupees in exchange for these foreign currencies, and we will try to speculate whether this currency will get stronger or weaker compared to our Indian currency. And generally, it is a good indicator of the import and export capabilities of a particular country. So if India imports more from United States, it has to pay United States companies through US dollars. United States companies will not accept rupees. Therefore, Indian importers who are importing electronics or other commodities from United States, they have to purchase US dollars to pay these US importers. India only has a limited quantity of US dollars with them. So the demand and supply forces will act accordingly. And as you can already observe, our currency consistently has been depreciating compared to US dollars. Even if you take, let's say, USD INR, it's currently 83.09, as you can see. And if you observe, let's say 10 years ago, so it was about 67 rupees 95 paisa about 10 years ago. So this basically shows that our currency has depreciated about 15 rupees per dollar in the last decade or so, and our purchasing power as a country has fallen by about 15 rupees per dollar on average. So India has been consistently been more reliant on United States and its not only products but also many of the services, and many of the companies that are providing jobs in India are also from United States. So many of these companies, when they make profits, they would want to withdraw that money and take it to their country. So let's say Google has branches in India and it hires Indian employees. And let's say Google performs well and shows up a profit of, let's say, any X amount of rupees. It would want to withdraw that money and take it back to its home country of United States. So that way, our country continues to be more reliant not only for jobs but also for commodity imports on many of these countries. Same thing applies to Euro. Same thing applies to Japanese yen, yuan, etc. So currency derivatives are a good option for people who want to diversify their investment. If you just are bored by investing only in companies and securities, this is a good option for you. But it's very volatile. There is extreme amount of fluctuations. Every day there will be significant fluctuations in currencies because it totally depends on the receivables and payables overall for the importers and exporters. The second category of derivatives are commodity derivatives. There are 6 major commodity derivatives in India. You have almond, you have cotton, you have turmeric, you have gold and silver, as well as steel. So these are the most commonly traded commodities in India. So if you buy a commodity derivative, you will actually not get almond or turmeric or cotton delivered to your house. This doesn't work like Flipkart, but whatever price fluctuations that occur in the price of almond or cotton or turmeric, that price fluctuations, you can make profits based on those price fluctuations. And many of these commodities are seasonal commodities. So you can predict whether the price is going to go up or come down, invest in these contracts, and then on the delivery date, you will receive the price variation. So you can either deal in spot markets, which are physical markets, or you can deal in the futures and forward markets. So future contracts usually are commonly traded in India in 2 positions. One is a long position and another is a short position. A long position is where the buyer agrees to receive the delivery of the underlying asset. And in a short position, seller agrees to make the delivery. In both the cases, long position focuses more on purchasing, short position focuses more on selling. So long position is usually taken by buyers, short position is usually taken by sellers. So when a futures contract is purchased, it is usually going to give you a long position. And when a futures contract is sold, it will provide you a short position in general. Apart from this, people who are also investing in currencies have options contract, which you can invest in. Now, options contract include the ability to back out of the contract on the payment of a premium amount. So usually you can pay a certain percentage of the contract value as premium, and you have the ability to back out of the contract before the due date. You can cancel the contract in case of options contract, and in case of futures contract, you cannot cancel this. Now, any institution which is having an overall open position of $1 billion US, you cannot go beyond that if you're an institutional investor. If you're a foreign investor, again, your open position meaning contracts that are not settled. Not settled meaning neither has the security been delivered, neither the price has been paid. Such contracts are called open position contracts. So you cannot exceed 15% of your overall open positions or $1 billion US, whichever is higher. So what BSE and NSE is asking you to do is, suppose you enter into 100 contracts, you have to at least complete 85% of those contracts. You have to complete those contracts, you cannot back out of them. That is what is the requirement in futures contract. Options contract also are of two types. You have call and put option. Call option gives you the right to buy. Put option gives you the right to sell. So, in simple terms, the right to buy gives you call option. Right to sell is given to you through a put option, and these options are usually traded at a specific price. That price is called exercise price. So if an option is exercised at 125, 125 is considered to be the price at which the contract goes through. So there are two ways in which an option works. In the European style, any contract can be exercised only on due date. So today is August 17th. Let's say you enter into 1 month future. That will be settled on 17th September. But in an options contract, you have two varieties. Either it will be settled on 17th September, which is a European option, or it can be settled before 17th September. Let's say if you are not having the patience to wait till 17th September, you can settle the contract on 10th September also. So this settlement happens before the expiry date. Such options are called as American options. So European options are settled on the due date or expiry date, and American options can be settled even before the expiry. So let's take an example of this and understand. Rajesh purchases one lot of Infosys May 3000 put. What does a put option give you? Does it give you the right to buy, or does it give you a right to sell?
Right to sell.
So give you the right to sell.
Right to sell.
You are buying a securities contract here. So it's a security based derivative. It is not a commodity based derivative because Infosys is a security. Now it is a May 3000 put. So 3000 refers to the exercise price. That is the price at which the contract is finalized, and you pay a premium of 250 rupees to finalize this contract. So this contract will allow Rajesh to sell one lot of Infosys. It gives you the right to sell, right? So one lot is usually 100 shares. So how will you read this entire statement that is given to you in the first line? It basically means Rajesh has the right to sell 100 shares of Infosys in the month of May for 3,000 rupees. And he has locked this contract by paying a premium of 250 rupees. So at any point between now and next May, if it's an American option, any time between now and next May, Rajesh can settle this contract. But if it's a European option, you have to wait till the month of May. On the due date only, you can settle this transaction. So whenever you settle this transaction, you have to pay a premium of how much? 250 rupees is per share. How many shares are you buying? You are buying 100 shares. So your total premium output is 25,000 rupees. This is your expenditure. So now in the month of May, let's say we take the same current prices. Put option is at 3,000 rupees, but the price is at 1,411. Should Rajesh exercise the put option or not? What do you think? Should he go ahead with the put option, or should he back out of the contract? If the price is 1,411 in the month of May, what should he do? What is the nature of Rajesh? Is he a buyer or seller? he a buyer or is he a seller?
Seller.
Rajesh is the seller. In the month of May, he has agreed to sell Infosys at what price? 3,000. How many shares of Infosys is he ready to sell? 100. But what is the price in the month of May? The actual price in the month of May becomes 1411. Should Rajesh go ahead with this put option contract or not? Or should he back out of it? What?
He should go ahead and make profit.
If he goes ahead with this particular contract, he will be able to make 3,000 rupees per share for Infosys, even though the market is only giving him 1,411 rupees. If he goes ahead with the contract, he is making a significant amount of profit. How much profit is he making? He is making 3,000 minus, let's take 1,400 as the round number. So he is making a profit of 1,600 per share if he goes ahead with the contract, but he also has to pay a premium of 250 rupees per share. So his net profit is going to be 1,350 rupees per share. So if this is a put option, Rajesh should go ahead. He should not back out of the option at all. That is the first example. Okay, now let's take another example here. Now, if an investor is of an opinion that Ray Technologies, which is currently overpriced in the month of February, and hence expects that there will be price correction in the future. However, he does not take a chance against the price rise. So the best option for the investor would be to take a put option on the stock. So let's assume spot means immediate delivery. The current price is 1040. That is in the month of February. The price is 1040. The May put option is at 1050, but you have to pay a premium of 10 rupees. And there is one more put option at 1070, and you have to pay a premium of 30 rupees. So the investor purchases 1,000 Ray Technologies put at a strike price of 1070, and he agrees to pay a premium of 30 rupees. So the overall premium is 30 rupees multiplied by 1,000 shares. So your overall premium is 30,000. Then there are two further scenarios. In the month of May, the actual price of this Ray Technologies becomes 1020, and in second situation, the price of this company becomes 1080, right? In which situation should he continue with the contract, and in which situation should he back out of the contract? Situation 1 or situation 2? He should continue or should he back out? What do you think? Yes. The main, yes.
Continue in situation 1.
Okay. What about situation 2? Again, you have a put option contract, you have the right to sell. So in the month of May, the actual price becomes 1020, but you have a put option contract to sell it at 1070. So you have a better price in the contract compared to the market. So you have a 50 rupees profit, but you have to also pay a 30 rupees premium. So your net profit is 20 rupees per share. You are selling 1,000 shares, so you make a profit of 20,000. In the second case, if it is 1080, you are getting a better price in the market compared to the price that is given to you in the contract. So in the contract, you have entered into a price of 1070 and you have the ability to sell because it is a put option contract. So in the contract, you can sell it at 1070, but in the market, the price is already at 1080. Should you sell it under the contract or should you sell it in the market? You should, in this case, sell it in the market and make 10 rupees extra. But since you have to back out of the contract, you still have to pay 30,000 rupees as your premium. So your net loss is 30,000 in the second case. Are we clear with how these options and contracts work? Any doubts? Okay. Another interesting part of the secondary market is your entitlement to different rights. So this is nothing but your rights issue. So whenever a company wants to raise money from its existing shareholders and they want you to subscribe to new shares, that is when they will do a rights issue. So any eligible equity shareholder can apply for their portion of the rights shares. Such rights are called as rights entitlements in our chapter and as per our terminology. So you have to apply for the portion of the shares that you are ready to take up. So let's say they announce a rights issue of 1:10. This basically means any person who holds 10 shares has the eligibility to buy one additional share from the company. So suppose you have 1,000 shares already with you. How many shares can you buy from the company? Additionally, you can buy 100 shares from the company. So that is your right entitlement. And if you don't want to buy these additional 100 shares, you can also renounce your right. Renounce means you are giving away your right to buy additional securities in the company. So that is called as renunciation. So either you have entitlement and you go ahead with the entitlement, or you renounce your rights to your entitlements. So all in all, the trading platforms in the stock exchanges are not only helping intermediaries, but they are also helping derivative contracts to flourish in the market. So overall, the trading platforms of stock exchanges are divided into 4 segments. You have the main board, which consists of the top companies of the country, which are listed here. Then you have SME platform, which contains small and medium enterprises. Then you have the innovator and growth platform, which supports startups. And then you have the social stock exchange plan. The SME segment has both BSE and NSE. The BSE segment is called BSE SME, and NSE segment is called as NSE Emerge. The main board is called as BSE and NSE main board. If you want your company shares to be listed on a stock exchange, you have to decide which platform you are eligible to apply for. If your company is in existence for many years and it is satisfying the criteria set by BSE, then you can directly apply to the main board. For this, you have to first apply for in-principle approval and you have to submit a draft prospectus. You also have to submit an application for listing your securities, and then you have to also apply for IPO registration if you are doing public issue of equity shares or any other convertible security. But if you're issuing debentures or any other type of debt instrument which are not convertible, then you can apply under the debt segment of the market. So the main board has 2 segments. It has the equity segment and it has the debt segment. Equity segment, you have to follow SEBI ICDR regulations in addition to the stock exchange regulations. And the debt segment, you have to follow SEBI ILDS regulations in addition to your stock exchange regulations. If you don't want to list on the main board, suppose you're a smaller company, you don't satisfy all the criteria of the main board, then you can apply under the BSE SME platform. You can only do this as long as your overall paid up capital post the issue is less than 25 crores. So it's very specifically targeted for small companies. You should have a positive net worth. Net worth means paid up capital plus free reserves. This should be positive amount. Your company should also have some tangible assets worth at least 1.5 crores. Tangible assets are the opposite of intangible assets like goodwill and other intellectual property rights. And there should be physically tangible assets worth at least 1.5 crores. Your company should also have a good track record of at least 3 years of incorporation record, meaning your company should at least be in existence for 3 years, and it should have a positive net worth for 3 years. Apart from this, your company should have a website. Your company should have a demat account agreement with the depositories, and your company should have a lock-in mechanism through which your promoters should not have changed in the last 1 year. You should have the same set of promoters, and additional people should not have been added to the promoter group in the last 1 year. If you satisfy all these conditions, meaning you have a post-issue paid-up capital of 25 crores, you have net tangible assets of 1.5 crores, you have operations for 3 years, you have positive net worth for 3 years, you have a company website, plus in addition to this, there is no change in the promoters group. If you satisfy these conditions, you will be eligible to be listed on the SME segment and Emerge segment. Same rules apply for NSE's Emerge platform also. The main differences between the main board and the SME board. Main board is far more stricter in terms of the compliance requirements. So your reporting requirements are quarterly in nature for the main board and half yearly for the SME board. Your post-issue capital has to be 25 crores for Emerge, whereas it is only 10 crores for the main board. But in order to satisfy this requirement, there are more rules, which we will see later on. You should allot your shares at least to 50 people in the SME board, and you should at least allot your securities to 1,000 people. So you should technically raise more money if you are going to be part of the main board. Your other red herring prospectus requirements, so that is your draft prospectus requirements, that will be monitored by the stock exchange if you are part of the SME board, but that will be directly submitted to SEBI if you are part of the main board. Your IPO should be 100% underwritten and 15% should be given to merchant bankers. Here also it is the same. Your market cap can be any size, it doesn't matter. Each investor should at least invest 1 lakh rupees if you are part of SME, whereas each investor should invest only up to 15,000 if you are part of the main board. So more investors can participate if you are part of the main board. You also have to issue securities to at least 1,000 allottees, so you have access to more people. But unfortunately, there is more compliance requirements here, and there is something called as market making, which is compulsory for the SME segment. Market making is the process by which you will appoint a stabilizing agent after your company's shares are listed, the company will appoint a stabilizing agent who will monitor the price of the company and its shares, and he will try to stabilize the shares and its prices. So that process of price stabilization is called as market making. That is compulsory for SLCM. Okay.